Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 15, Why Clean Financials Matter More Than High Revenues. Now, if you're looking to get a loan, get an investor, sell part of your business, or sell all of your business, the concepts and strategies that we talk about today are going to be highly valuable for you. Because messy books don't just reduce valuation, they kill deals. Buyers don't pay for revenue they can't trust. If your controller quit today and walked out the door, could someone else reproduce accurate monthly statements, information, and even closeouts for you by a specific date? And if the answer is no, you may have some problems on your hands. So here's your core thesis. Financial clarity is deal fuel. It's what moves the deal forward. High revenue with poor reporting creates uncertainty. Uncertainty becomes discounts, holdbacks, walkaways, or we're never going to touch this thing at all. So your job today, right now, is to rate your confidence on a scale of 1 to 10 for your accounting. 1 being, there's no way that my accounting is accurate, and 10 being, my accounting is perfect, and if we wanted to sell right now, I could drop the books on the table. And if you're anything below an 8, really take this at heart today. Trust beats size when it comes to a deal for a buyer or for an investor. Buyers want reliable, consistent numbers to underwrite debt, returns, and growth plans. There is Excel Eddie sitting in a cubicle waiting to drop your information into some sort of format to double check what you've said. And if the ratios aren't right, it's a ding against your valuation. And so the way that deals are done typically and roughly looks like this. An A-level deal means that everything is ready to go. It's the type of deal that an investor wants. It is the thing that they desire. B, maybe there's a couple things wrong with it. C, there's more than a couple things wrong with it. D, we're not going to touch this thing possibly ever because there are lots of problems. So if your financial story isn't coherent, the multiple gets reduced no matter what the top line is. So smaller companies sometimes with clean financial reporting can out-multiple bigger ones with chaos. Chaos means that you're going to lose money on your multiple. Clean financials equal predictable performance. Clean isn't just the accuracy of the bookkeeping, it's consistent end of the month close, clear revenue recognition, stable margins, forecasting that's credible. Buyers and investors pay for the ability to predict. So your role, your responsibility is to commit to a defined closing timeline. Like, when are you going to close the books? When does it need to be done? My belief is on a company, the book should be closed out on the 8th or 9th or the 10th. And I want to tell you a story. I'm going to tell you multiple stories, but I'm going to turn them into one. As an advisor and a consultant, it's not uncommon for me to go into a business and say, hey, listen, the books really need to be closed out by the 8th, 9th, or the 10th. Like, for reals, we're going to get this done. Okay. Owners on board, owners are on board. And then we get to somebody at the bookkeeping level. And they say, it's impossible. We're backlogged. We can't do it. Okay, I go into answer mode. Well, the answer is we're going to hire somebody that's fractional to get this done. We're going to bring somebody in. And then the answer is, no, we can't do that because they're not going to understand our accounting. No, we can't do that because I can get it done. No, we can't do that because I can't trust them. And for me, that raises flags. And I'm going to share with you why. When I was getting my MBA, my accounting professor was an auditor for companies. He was a forensic accountant. And he said, hey, Scott, when somebody can't close out the books, it could be incompetency. It could be that they're behind and they're not good on delegation. He said, those 2 things are real. But he said, sometimes it's nefarious. Sometimes it's because the books are being cooked. Sometimes because there's money being taken. And sometimes because there's shell games being played and the owners really don't know the financial state of the business. If you want to be taken seriously from a buyer, an investor, you should have a date that you pick up on and say, we are going to close our books out by whatever date it may be, 7th, 8th, 9th, 10th, or 11th. and then accept no excuses for it not being done. And I really mean that, because if you start accepting this excuse, it'll never get done the right way. Now, you may say, hey, Scott, I'm not looking to sell. Okay, you don't have to. But if you're ever looking for a loan, the speed to have accurate books on a loan matter. If you can get into a bank and say, hey, here's everything that we need, and it's accurate and done right, great. If you're going to bring in an investor, great. But if you're looking to sell and you have history is the key of like, listen, we have closed out consistently on the 8th, 9th, 10th of the month for the last 5 years, 4 years, 3 years. Here is our consistent history. Those are the things that buyers have the potential of drooling over. When you take a look at how messy books show up in due diligence, it's inconsistent statements. It's missing schedules, unexplained variance. And we'll get to that later excuse. You get skepticism from the investor or for the buyer because they're saying like, hey, listen, there might be a problem here, so we're going to have to slow down the timeline, or we may have to reduce the multiple. When you take a look at your business and your organization, what questions does your team routinely struggle with? And how could you get them to answer faster? Because this is going to help you get to the speed of your multiple. For you, you want to take a look at the normalization and the add backs that are going to happen. Buyers, they're going to adjust your EBITDA, which means that you're getting dinged and dented if you don't have information that's accurate. When the story is clean and repeatable and you can tell the narrative, that's what they're looking for. Hey, we got questions about what's going on in the month of October. What happened? Hey, we changed up our process. We got a new CRM. Yeah, that's an easy question to answer. We figured you were going to have that. So we have it documented. Here's some footnotes for everything that was going on. We had this prepared for you because we figured you were going to ask. So what you want to do is you want to build documentation, an add back file with receipts and clear logic and say, hey, here's what we're taking a look at. Here's how we got to our answer. Here's how we got to our core thesis. There is a cost of cleanup. If a buyer or investor comes in and says, hey, I'm going to purchase this company, they may back charge you for the fix that they have to do. And it may be like, hey, we were going to give you $1 million for your business, but now we're going to take $50,000 away. So they price in what it's going to take to fix the reporting, the controls, and the processes after the close. Or this may come back in the terms of holdbacks and clawbacks and saying, hey, you were not ready for us to buy your business. So it's better for you to put these systems in place now and take a look at them and think of them while you can to get the maximum multiple. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. Lines are going to help you either way. You don't always have to be ready for a formal audit, but you do want audit-like discipline for the actions you take inside of your business. You want reconciliations, consistent categorizations, and clean support. Buyer grade reporting means you can answer why questions instantly. So start your monthly balance sheet reconciliations if you haven't done that already. As you take a look at the purchase of a company, forecasting credibility is a valuation lever. It's something that can help you get a better multiple for your business or reduce your multiple. If your forecasts are consistently wrong, it's tough for you to make good decisions. Buyers will assume that you lack control over your business or your organization. Forecast accuracy means that maturity is in the business and it reduces perceived risk. So over the last 6 months, how close were you to your forecasted goals, revenue, and margin? Were they off? Were they not on board at all? And if you're documenting this as you go, remember, buyers, investors, they're buying your history. If you can prove that the trajectory is up and it's the hockey stick, it's the proverbial hockey stick that they teach in MBA courses, then you can go to bat and say, I want a better multiple for what I'm getting. I don't want the standard deal. A standard deal is for a standard company, and we have consistent growth year over year. The industry says 10%, we're at 20%, we're a premium company, and we want the money to pay for it. As you take a look when somebody comes in and it's Excel Eddie, working capital surprises kill trust. And that could be unmanageable receivables, payables, inventory, cash flow volatility. Buyers, they don't just look at the EBITDA, they're looking at the conversion that it's going to take for them to get paid. So you want to track DSO, DPO, and inventory turns to explain variance if it comes up. And if you're like, hey, Scott, never heard of DSO, I got you. DSO is days sales outstanding. And the way that you take a look at it is how long does it take for me to get paid? I deliver my good, my product, my service, my consulting. How long does it take to get paid? 1 day? Oh my goodness, that's amazing. Long term? Not so good. And as a side note, I took on a consulting client back in the day, and their DSO was 18 months. It took them 18 months on average to get paid. They were financing deals for people without charging interest. So if you were a credit card company, think about it like this way. If you were a credit card company or a bank, would you let somebody get 60, 90, 120 days outside of, or months outside of payment before you collected some sort of money, part of the money, or all of the money? And DPO is days payable outstanding. Like that's how many days you're sitting on the bill before you pay it. And people who haven't been trained in sophisticated bookkeeping will pay bills instantly. That's okay. That's one way to do it. The more sophisticated version is to go after longer terms because you're able to sit on money longer. And so some of the people that I work with, when they go in and negotiate, they'll negotiate a lower price. Okay, that's cool. You could do that. Some of the people that I work with, they'll go in and they'll negotiate not just a lower price, but better terms. And then when somebody comes to them and says, hey, we're going to raise your prices, they go, that's fine. We'll still use you as a vendor, but we had 30-day terms. We want it to be 60. And so my rule in life is if anybody wants to come back and renegotiate with me on their side, they're getting something on my side as well. And you can absolutely request this, or you could go shop for a new vendor. Preparation and data room readiness speeds up the closes. If you can produce books and just drop them on a table and say, hey, we're ready to go, the clean financials or reduce diligence friction, and they keep momentum high. And if you don't know what a data room is, think of it like a secured Dropbox. Think of it like a secured online folder on the cloud, where it's stored, it's got passwords, it's got certain encryption levels, your financials go there, your data about your business goes there, it gets uploaded, and then Excel Eddie takes it from there. Excel Eddie loves data rooms. Momentum preserves the leverage that you've built inside of your business. Slow diligence creates recognition windows that you don't want, and it'll lead to renegotiation. Clean data prevents retrades late in the process where people come back and said, hey, we had a 5 multiple for you, and now we're going to give you a 4. Or you were going to get $1 million for your business, and now we're going to pay you $900,000. Your systems matter. If the reporting depends upon one person and their heroics, that's a risk. Your buyers and investors want repeatable financial processes with controls and documentation. So you should have SOPs. Your accounting team, your accountant, your bookkeeper should have SOPs. And as we mentioned earlier, there should be a closeout date, an X date as we like to refer to it as, for billing, expense approvals, for inputting data into your bookkeeping software. You can start small, but eventually you want to get to the point where everything is done by a certain day of the month, 8th, 9th, 10th, or the 11th, preferably the 8th at the latest. That's just my belief. You could pick a different day. As you take a look at what's going on with financials, there are some common founder mistakes. It could be mixing business life with personal life, inconsistent coding, unclear owner compensation, creative categorization. I can't think of a business or an operator who hasn't creatively figured out a way to put something into an Excel file. And too many of those goes against dings and dents in the ownership and the payment that you're going to get into the future. You want credibility here. And so the question about credibility comes down to this. Would a buyer view your books as a decision tool or a tax artifact? Would a buyer look at your books as a decision tool or a tax artifact? You want to be on the right side here. So I've got a 90-day cleanup routine for you. Standardize the chart of accounts, lock in your closeout cadence, reconcile monthly, document your add backs, and build a 13-week rolling cash flow forecast. These steps, they help build confidence in the purchase or the sale of the business. So assign one owner or two owners the financial quality and weekly or monthly accountability. And if you don't have the ability to get this done, get the help and pay for it. Now remember, earlier in this episode, I shared with you, there are all sorts of excuses that you're going to hear. And so if you're hearing the excuses, it's a sign for you that you may have to pay somebody 20, 30, 40 bucks an hour for a month to come in and clean up your books. I'm going to take this excuse because somebody says they can't do it or that they're busy. At some point, this has got to get figured out. Because if that person leaves, I want you to think about this. If that person leaves, you're in serious, serious problems. Because they're so far behind, you're going to have somebody come in and fix it anyway. So there's a saying in sales. It's a close. Either way, you're going to pay. And whether you pay somebody to come and fix it or you got to pay somebody to come in and fix it because you're in trouble, either way, you're going to pay. You don't need to be perfect. You need to be trustworthy. You need to be explainable and consistent. So this week, pick one financial friction point, close of speed, reconciliations, add back documentation, forecast accuracy, and fix it. The question for you as we close is, could your numbers survive buyer scrutiny without you having to narrate them? Mahalo for listening to the Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.